Good morning.
Good morning.
And welcome to not new members now, they've already been to one meeting, but it's my first opportunity to say welcome to Mark and to David. And we're welcoming Jim and Brian also. Good to see you again.
You too.
We're ready to call the roll, Gail?
Yes, ma'am. David Harrington, Herman Covey, Mark Gardner,
Here.
Landon Moore,
Here.
Mark Munson,
Here.
Laura Bellin,
Present.
David Holly,
Here.
Derek Challenger,
Here.
Solomon Ashby, Elizabeth Gooden, Cheryl Spivey.
Here.
You do have a quorum.
Thank you. Looks like the first order of business is election of new chair and vice chair. And I appreciate the board delaying the vote so that I might have an opportunity to let you know that I am interested in chairing if the board so agrees. So I'll put my name forward. Are there any other nominations?
I second the motion that you forward that you serve as chair.
All right, we ready for the question? Everybody in favor?
Aye.
All right, so move. And thank you for your support. So close to election day. Next order of business is our vice chair. Do we have any nominations?
How do you feel about it, Landon?
I'll do it.
I nominate Landon Moore as vice chair.
A second.
All in favor? Aye. Ayes have it. Congratulations, Landon.
Thanks.
Thank you. All right, Gail sent the minutes forward earlier this week, or maybe even Friday, I'm not
Friday.
sure. And hopefully you've had a chance to review them. You all look good on camera too, so on YouTube. So I had a chance to check that out as well. May I have, if there are any questions or corrections?
Yes, I've got questions on the members present.
Yes, sir.
I am not mentioned in here, and David Harrington is mentioned twice. So I'm just wondering if there was
There is.
Yep. I will make sure I correct that.
David Harvey, who's that?
I believe that she mistyped and I missed that one.
Should be Holly.
Yes, I will make that correction. And I will resend these and submit them again next month to be passed.
If you just call somebody David or Mark, you have a good chance of being right.
Yes.
Item 3, I think Harvey should be Herman Covey. Is that correct?
That is correct.
See some more red marks.
Is this the time to ask questions concerning the content?
Yes.
On page 4, it was mentioned discrepancy in the monthly report. Did we get that resolved? Hancock's
I think you
resolution?
might have left when
Okay.
Tom got his
That's why I was
response.
asking, because I had to leave early.
Yeah, I think he had already left.
Okay.
Tom determined that that was because of how they classify some people that are on workers' comp versus how we classify
Okay,
them.
all right. And on page 5, Mark asked for a comparison of self-funded funds.
I will have that later in the, well, I had planned to bring that forward in new business, but I do.
Okay, that's
I do
fine.
have that, yes.
Okay, we've got that information
Yes.
then, right? Okay. Good.
All right. Thank you. Any other comments or corrections, edits, additions? If not, I'll entertain a motion to accept them.
Move to accept as corrected.
All right. A second?
A second.
All right, all in favor? Aye.
Aye.
Aye. All right. All right, Gail?
We only had one, excuse me. We had one reported death, William Gerganis. He was with the supplemental plan, no death benefit payable. Active participants as of November 1st are 21 in the fire and police and 15 in the supplemental.
All right, and we'll move on to recurring business report.
Year-to-date, as of September 30th, beginning balance, $219,110,313.57. Administrative expenses, $574,061.35. I'm sorry, that was interest income, my apologies. Administrative expense, $25,214.87. Return of benefit payments, $2,004.06. Recurring benefit payments, $7,407,194. Realized gain, $154,979.62. And an unrealized gain of $3,892,706.13. There was a net loss for the year of $2,808,657.71, with an ending balance of $216,301,655.86. This is a $13 million difference since the same time last year, a decrease.
That fee of $25,000, is that an annual fee or quarterly or semi-annual? How is that paid out?
It's based, part of it is the annual, our quarterly bills, which you actually have copies of. That's some of the John Hancock that needs approval, administrative bills. The other part, and I'm sure you gentlemen can probably explain it better than I can, is the required revenue. We get some revenue back from some of our funds, but then the difference we have to make up.
All right, any other questions about the recurring report? All right, the next is the OPEB trust status.
The OPEB, as of the end of September, the cost value is $2,999,375.48. The market value is $3,152,596.27. This is the fund that we put money into. I believe it was in May. We put $3 million in there.
I have a update specifically to Vice Chair Landon Moore's question from last time in reference to the OPEB trust. I think the last time we were talking about the local finance board as it relates to the Virginia OPEB, and I was able to do some research and find out some answers. The Virginia Pooled OPEB Trust Fund Agreement allowed the local finance board, which is the retirement board, to designate one or more, but less than all of its members, to serve as an authorized representative of the local finance board for purpose of the Virginia Pooled OPEB Trust Fund. The annual meeting of the local finance boards for the election of trustees shall be held between September the 1st and October the 31st, as shall be designated by resolution of the Board of Trustees. At this meeting, each local finance board is entitled to vote, and voting power is based on the amount invested. The email notices are going to Cheryl Spivey and Gail Mosher, and a hard copy of the annual meeting notice is going to Cheryl Spivey, who is listed as their primary contact. There are currently 9 Board of Trustee members with the Virginia Pooled OPEB Trust Fund. So that's pretty much what it is. So there is no requirement that we're there. but if we're there, we're not there, we're not voting. So that's kind of how it works. And right now, the 9 trustees right now, they are from all over the state. A lot of them are from more the larger jurisdictions. I think one of them, the only small jurisdiction I saw was the city of Salem. So that's kind of how the local finance board interacts with the Virginia Pooled OPEB Trust as it relates to trustees. Did that answer your question?
Yeah. So I guess the question is, should we go to those meetings and vote?
From what I've was able to determine, it's not only just the vote, because by resolution they can dictate even other things beyond just voting. So it probably would be a wise thing to go to at least know exactly what the extent of what's being discussed at the meeting. And so the next opportunity for this would be September the 1st, somewhere between September the 1st and October the 31st of 2019.
Did we get a copy of the minutes from the last meeting?
This is new information for me. So, and apparently I'm the one that they have listed. So,
What I can do is make a request to the same email contact that I have to receive the minutes from the last 2018 annual meeting, and I'm sure they'll be happy to provide it to me, or they should be happy to provide it to me.
Now, are those meetings recorded, do you know?
I don't know. And I can find that out too, whether or not it's available like our meetings are
Right.
on YouTube or some other comparable platform. So I will find that information out and report back at the next OPEB trust status time.
This is not familiar to me.
it's not to me either.
You mean the OPEB trust in general?
Yes.
And I'm going to give you my understanding of it, and Ms. Spivey can correct me or, address the part that's more financial in nature. Last year, we decided to do the Virginia Pooled OPEB Trust. It went through council. There was a resolution, and consequently, it was for the purpose of funding our OPEB responsibilities. And consequently, we deposited $3 million into this account that was funded through City Council. And there was a resolution that was adopted to adopt a trust for other post-employment benefits. And as was mentioned earlier, the post-employment benefits we're talking about is health insurance. It's not for pensions. And there's a whole statute, which is 15.2-1500, that deals with this type of OPEB trust fund that can be established. And the County of Fairfax and the County of Henrico were the first to jointly establish and participate in the Virginia Pooled OPEB Trust Fund. So we have this, and then there was something called the Virginia Pooled OPEB Trust Fund Agreement. That is where I was reading from and got the information as it relates to the actual meetings. So the Virginia Pooled OPEB Trust Fund allows any jurisdiction in the state of Virginia to, in essence, get the benefit of pooling their resources together so they can get the best investors, investment advisors, and not be involved with the administrative aspects of doing it yourself. And it's my understanding what we were doing before then, we were paying it as we went along. So now we're actually funding it and getting the benefits of the money being able to grow in the actual fund, as opposed to just paying it as you go without the benefit of it being invested. So that's kind of the whole purpose of it. So as of now, we've only been in this pool trust fund for less than a year, my understanding. Yeah, less than a year. So that's kind of the overview of it. And if you would like, for the next meeting, I will make a copy of the resolution and the Virginia Pool OPEB Trust Fund Agreement, and I just provided to everybody.
Derek, I have that electronically. I can send it out to everybody.
Which shows you how I've been doing things kind of the old way.
Do we
Nothing wrong
do we
with
know
that.
how much money total they have?
The whole,
The whole trust fund?
I have no idea. But I know there is a list of who are the participants, and there are at least 50. Because you add in, because a lot of them have the city as well as the school system. So you may have like the city of Newport News, and then you have Newport News Public Schools, and maybe even Newport News Redevelopment and Housing Authority. So it should be a significant amount of money because we're talking about a large number of municipalities.
I mean, it's got to be hundreds of millions.
I would think as a participant, we could have access to the financial statements.
Yeah, as an example, I missed the last meeting because I was out of town, but the OPEB board for the school system was probably getting ready to move into that, and if they did, they were moving about $12 million over.
And I'm sure they can tell you there's a lot you can do with hundreds of millions versus 3 million.
Right, exactly.
Is it our intent to pay the insurance, and I don't know how our insurance, if the city's self-insured or,
Self-insured.
so is our intent to pull money from time to time from the trust to pay for those
Health costs?
costs?
Yes. To pay the city's portion of the health insurance and then to pay the claims.
And you'd pull money like once a quarter or something?
We have not started pulling the money yet. I don't know if that's been completely discussed and determined yet.
And do our retirees or potential retirees, are they part of this pool? Do they contribute?
No,
No.
no. They have their portion that they have to pay of the insurance. Same as I have a small portion I pay, the city
Right.
pays the rest. It's kind of flipped. The city doesn't pay as much for the retirees as they pay for the employees.
Right.
But they also pay, I pay my copay, retirees pay their copay, city covers the rest of it up to the age 65.
And it may be good, since Ms. Gooden isn't here today, if we, she's the one who has more information on the benefits. If we could maybe add to our agenda next month, let her explain more about the benefits.
She can tell us what the exact dollar benefit is that a retiree gets.
Yes,
Yeah.
yes.
And just in the interim, I have the paper right in front of me. It had, they said assets of more than $1 billion. And it said the Virginia pool trust is among the largest, but it said more than $1 billion.
I think it would be helpful if we could get the minutes from the last meeting. I think some of that financial information would probably be in there, be available.
I have it on my list to do.
And then I guess next meeting, maybe we should designate somebody and go to the meeting next year.
If Cheryl's name is there,
Yeah.
And I don't know if, does Cheryl, I guess it would be in Richmond?
I think they changed the locations. It doesn't
Hope
have
it's
to
not
be
in Roanoke.
Yeah.
Yeah, I don't know if we can designate one of y'all to go, or if it has to be one of us. It could be staff,
or it could
ex
be one
officio
of
members.
each.
I don't know the answer as to who is, because it says, if I remember correctly, it has to be a member. Because it says, allow the local finance board to designate one or more, but less than all of its members to serve. And for instance, Ms. Spivey and Ms. Gooden are ex officio members, so they're not allowed to vote. So it'll have to be, the board would have to appoint one or more, but less than all of its members to go. So it would seem to me to be a resolution by the board or a vote by the board to say we appoint A and B to go.
Yeah, so the communication comes to Ms. Spivey.
Based on what I have learned today, it does, but I don't recall it. I would have brought it to you.
Well, this joining is very recent, so you may have not gotten anything
Yeah,
yet.
so I will.
Would it be
I had
possible
thought-
to see when the next meeting is and where it is, so that we can discuss that if
Yeah.
any
Yes,
representation?
I'll reach out to them and find out,
I'm thinking it probably won't know again until maybe June of next year or something like
That's
that.
what I'm thinking too.
We just know the general time frame right
Yeah, we
now.
just know that it has to be between September and
Oh.
October 31st.
Okay. Well, we'll move the update about what this is and how it interacts with us up to the next meeting. And then when we get closer to invitation, we'll decide who might be available to attend, if that's okay with everyone.
Yes.
Okay. All right. Thank you. That was more than I expected, but I'm glad we got to it. All right. On to the next item, appointments to the investment committee. Let's see. I believe that Mark and Landon are current members.
David Harrington.
Yeah, David
And
is.
David.
I'm not. Those
Matthew
two are.
Crutcher was.
So we lost
We
Matthew.
lost Matthew. All right, so we need to fill that one spot then, assuming that David wants to continue to serve, and we'll ask him if that's true.
And what does the committee do?
Landon, you're the,
So in the 1 year that I've been here, we had, basically one meeting or a couple meetings to work on the RFP to hire an investment advisor, which we selected Greystone. I think moving forward, it's just from time to time when we need specific items or topics come up that the greater board doesn't necessarily need
Right,
to
okay.
opine on. So for instance, we were talking with Greystone about working on an asset liability study the end of this year or next year, and that's something that the investment committee could work with Greystone on and then report back to the board at the meeting. Basically, if there's, investment-related topics that come up in between meetings or from time to time that we can report
I
on.
would be interested in that.
all right, we have a volunteer. Is there anyone else who wants to?
Run with it.
All right, thank you, David. You are a new member, and we'll follow up with David Harrington to see if he would like to serve. I think 3 people is adequate. Out of-
3 plus Cheryl.
Of course.
We need to vote on that.
I don't think so.
I don't think it's required.
If he volunteered.
Winning position, right?
Well, by acclamation. All right. It's time to move into our presentations from Jim and Brian.
Great. Well, thank you and good morning, everyone. It's a pleasure to be here with you today. I think before we get started, I just want to introduce one person in particular that's on the phone. Suzanne Lindquist is part of our outsourced Chief Investment Officer group, and given the RFP and that you all went through earlier this year that resulted in our selection in that capacity, we're adding additional members of the team for additional levels of support and oversight. So she wasn't able to be here in person today, but hopefully the next meeting when we get together, you'll see her. It's still Jim and I that are responsible for this program, but working with Suzanne as an additional resource is how our team is structured going forward.
The last name is Lindquist?
Lindquist.
Good morning, everybody.
Yes.
Good morning.
Good morning.
The other person that's on our phone is a new colleague of ours in Chicago. Her name is Mackenzie Howe, and she's just dialed in to listen and hear what goes on at board meetings. So we thought it would be useful for her to listen in as well. I am going to speak, Jim and I are going to speak from this report here, the third quarter 2018 performance evaluation for Portsmouth Fire and Police and Supplemental Retirement Systems. There's really three things on the table of contents before tape one that we're going to talk about. Jim's going to review the third quarter of 2018 from a capital markets and economic perspective. As you can imagine, the world is quite different today than it was in the third quarter, and so we'll give you an update as to what's going on in October and the early part of November as well. And that really kind of folds into what our outlook is for the near term, really the remainder part of this year and for early next year. And then we're going to review total fund results. We'll look at individual investment manager performance, and happy to answer any questions that the board has. But I guess given that there's a number of new members on the board that didn't have the opportunity to go through the RFP process and evaluate the different providers and understand the historical relationship we've had with the city and the pension systems, I think it's probably important to spend a few minutes just kind of talking about that history with the board, just to kind of level set the historical context as much as we can in a short period of time here. So we've been involved with the city and the pension systems in a very limited capacity. We were originally hired back when our team was at Credit Suisse, back in, 2012.
I guess.
With the sole purpose of overseeing a single manager that was and continues to be in the investment program, and that manager is Schaefer Cullen. They're a large cap value manager, U.S. equity manager, and our sole responsibility was to provide due diligence and oversight of that portfolio. And the reason that we were responsible for that is because we were able to bring this manager to the fund at a much lower cost than you would have been able to access it if you went to them directly. So in addition to getting that manager for cheaper fees, you got the oversight of our team in terms of what is the manager doing a good job? Is it doing what they're supposed to? Is it maintaining true to its style? There was another advisor, the plan used another advisor for a number of years that was responsible for overall asset allocation and manager selection. And quite frankly, that advisor was responsible in working with the board in saying we should put this much money in this asset class or that asset class, and in addition to that, we should have this much money in Schaefer Cullen. So we weren't responsible for the allocation decision. What we were responsible for was making sure the manager was living up to its billing and doing a good job for the city. As time went on, and there had been some change, particularly at the staff level, with the former CFO who's no longer here coming on board, and largely as a result of an independent study that was done around the governance practices of the plan, where there were a number of issues that were identified in that study. You all might be familiar with the Davenport study. She took it upon herself to, in working with the board, to bring about a lot of changes that were needed as a result of the outcome of that study. One of the outcomes of that study was a suggestion that the board and the plans have a more sort of institutional approach to what was going on the investment side, whether it's sort of broad oversight of the pension plan, whether it was manager selection, whether it was performance evaluation. There were a number of issues that were identified that was suggested be addressed. And so the former CFO, and again, in working with the board, started to look at that issue and see what remedies can be made to address some of those concerns. As we began talking more to the former CFO about additional things that we could do, given our background and our experience, what became clear to her was that we could help the board address a lot of those concerns that were identified in the study and do it rather quickly. And so we committed to the CFO back about 18 months ago now that if you give us the opportunity, we can fix a lot of these concerns. And in fact, we did that. And in the RFP process, there was this table that showed here were some of the concerns that were raised, and we had big red lights flashing, and over the course of a 12-month period, we changed all those red lights to green. So we addressed all of those concerns around governance, around performance evaluation, around sort of the institutional approach to fund management and oversight of the pension plan. The reason why we were able to do that is because we operate every day in the institutional consulting world. Jim and I have worked together for about 7 years now. Prior to working with Jim, I was head of public pension fund consulting for the largest consulting firm in the world. So I know the issues that you're facing. I know the challenges that public retirement systems across this country face. And I've worked in board settings like this and others to address those issues and hopefully create investment programs that are going to stand the test of time, that are very sort of institutionally focused in terms of what their exposures are, the investment strategies, and the managers that are used. So we come at this, and we come to this board, quite frankly, with that perspective in mind, whereas I think the prior advisor that was being used was maybe much more focused on sort of individual investment strategies for people. And that's a very different dynamic than what goes on, particularly in a public board setting. And so I just want to, for the new members in particular, convey that we have a lot of experience in working with plans that look just like you. So we got through that process, and I think rightly, because the board hadn't gone through the RFP process in a number of years. Quite frankly, I don't know when the last time the board issued an RFP for an investment advisory services, and we participated in that process and ultimately were selected as the board's advisor. Now that relationship is changing. In the past, when we took over about 18 months ago, sort of a more holistic view of the plan, we always operated as your consultant. So we provided advice, we provided recommendations. Sometimes those issues went through the investment committee, other times to vet the topics, and then ultimately bring those to the board for approval. But during that RFP process, the board had decided, well, maybe we want to have a different relationship with our advisor. Maybe we don't want them to come and provide options and recommendations to us. Maybe we want them to take discretion on our behalf. And so that's the relationship that's in place now, really effective November 1st of this year. And so that just gives you at a very high level, our involvement has been fairly long. Our involvement in being responsible for the overall portfolio has been very short. And the relationship as it exists today is very different than it was even 12 or 18 months ago. So with that, let me just stop there and see if there are any questions, or if something is unclear, I'm happy to address that. No.
So Greystone has discretionary over pot of money.
We do. So the relationship that exists is that we are going to work with the investment committee and the board really in a more of a traditional advisory capacity to set the overall asset allocation strategy. And by setting the strategy, we're going to go through this process that Landon talked about of doing an asset liability study. That's one of the reasons why Suzanne is and her group is part of the team now. They spend a lot of their time looking at those issues. Once that broad asset allocation strategy is set, we then have responsibility to go out and implement that with the third-party managers we think most highly of. Okay. So in emerging markets, which manager are we going to use? That's sort of up to us. We're always going to tell you what we're doing, but the plan in place and the relationship in place is that we don't need your approval.
Right. I understand.
Okay. Any other questions about that? No?
So that is the next step for us, is to meet with the investment committee and work through this asset liability study, introduce Suzanne more formally to the team, talk about the portfolio, level set it for the investment committee, and then we'll have a broader discussion with the board. So that's next on our agenda, is to schedule that date and time with the investment committee.
And what is the time frame for completing that study?
We've already started pulling some information together, and our thought is we're going to have a very robust review of the liability side of the equation in addition to the asset side, and what is common and what is required in the public sector, and contrasting that to what's typical in the corporate sector. So it's going to be my guess, given that the holidays are coming up here, that we'll probably schedule an initial meeting with the investment committee sometime in maybe mid-January. We'll kind of hash through some issues. We'll go back and do any additional work that's needed, but have sort of a formal plan in place around where we want to go and how we're going to get there, and then have the board approve sort of that overall strategy recommendation probably at the, what would it be, February board meeting, and then implementation from there. Depending on how different the strategy is that is proposed, the new strategy is from where we are, it may take a period of several months to actually implement those changes. If we're pretty close to where we want to be today versus where we want to get to, that can be done pretty quickly. But if there are sort of drastic changes, we don't want to make all those significant changes all at once. So I think you could probably think around, from here, certainly within 6 months.
Any questions about what's transpired in the past or the way forward? We just want to make sure we have this conversation today, level set it for everybody, particularly for our new members.
Sound good?
Great, thank you.
So I think Jim will now kind of review third quarter and sort of outlook, and then I'll get into the actual portfolio results.
Again, good morning. Jim Whitney. I'm delighted to be here with you today. I'm going to ask you to turn to tab 1 in the book that we handed out just prior to the session starting. And I'll begin on slide 4. This morning, I'm going to review the capital markets third quarter review with you, and then I'll talk about the financial markets. Normally, what we do is we look at more of the macro trends that are happening at the quarter end. In this particular time, however, because we've had a lot of volatility into the market, we've had a member of our Global Investment Committee provide us with a real-time update of what's been happening in the market. So a little bit of a difference to what we've done in the past, but I think you'll appreciate the more dynamic nature of that update. So let me begin on page 4 with the third quarter overview. Essentially, the summer of 2018 blended very nicely into the third quarter with very, very little volatility. As a matter of fact, we didn't even experience a 1% correction during that time period. Of course, things have changed. During that time period, the market reached an all-time high. And there was also a continued divergence with markets around the world, both international equities and emerging markets in particular. And that was primarily driven by different levels of growth around the world, geopolitical issues, and currency pressures. So we'll review that in some detail in just a minute. Overall, the S&P rose 7.71% for the quarter. All 11 sectors finished in the black for the quarter. So it was a resounding positive quarter and contribution from all sectors. The Dow Jones Industrial Average rose 9.63% for the quarter. Let's take a look at how the indices performed in the U.S. on slide 6. So for the quarter, A terrific quarter for the S&P 500. I'm at the bottom of slide 6. S&P 500 up 7.71%. The Dow up 9.6%. Small cap stocks, Russell 2000 up about 3.5%. And I think what's important is to look at the 12-month period prior. And I'm going to address this in a slide in a few minutes when I talk about our current thinking on the market. That's a stunning 12-month period of performance. So for us to experience some volatility or a pause after those really strong results, I think has to be expected. Now, if we look at performance to date, things are much different, of course. So we've had one of the most powerful post-election rallies since 1982, yesterday. And so these numbers have been improved. I would speculate now that after yesterday's results, the S&P has rallied to a little over 6% year to date. So we can lift all these numbers, but as we'll see in a few minutes, the numbers on the international side aren't quite as good. So let's review those on the next slide, which would be slide 7. And if we look at the third quarter results, MSCI, EFA, Europe, Australia, Far East, up just a little over 1%, a little bit of difference between growth and value, and Europe up barely at 84 basis points. And if we look at the 12-month results, reasonably good, but pale in comparison to the U.S. market. So if we look at the quarter for the S&P up 771, it really dominated the rest of the world by a great extent. If we were to look at these numbers today, I updated them through the 5th of November. Things have gotten decidedly worse, and the extreme performance of the U.S. versus the rest of the world has been even more magnified. So the EFA, the first benchmark there, is down about 8%. Europe is down a little over 8.5%. And the big difference has been in the emerging markets, where we do have an allocation that's now down double digits.
From September through
That's
5th of November?
No, so double digits would be year to date.
Okay,
Through
12-month trail?
No, just year to date through the 5th of November.
Okay.
If we're looking at slide 8 for a minute on the U.S. bond market, the Bloomberg Barclays aggregate broad measure of taxable fixed income rose 0.2%. During the quarter, the 10-year Treasury rose from 2.86% to 3.06%, so modest increase in rates. And if we look at the performance for the quarter, modestly negative across various asset classes, except for high yield because of the higher coupon relative to the rest of the fixed income asset classes. And for the 12-month period, again, high yield is a standout because of its higher coupon at 3.12%, but generally slightly negative across the spectrum as a result of those rising rates. So that's a quick review of the capital markets for the third quarter. I'd like to spend the rest of my time just talking about what happened during the quarter and sharing with you some of our views. It's on tab 2. As I mentioned, Andrew Slimman is a member of our Global Investment Committee, and he provided this more real-time update for us, and it's titled, which I thought was appropriate, "A Bump in the Road, Not the End of the Road." Let me walk you through some of his thoughts. So on slide 20, at the beginning of this year, Andrew wrote that he thought this year we were ripe for some mean reversion in the financial markets. And of course, mean reversion is one of the most powerful concepts of investing. The first thing he wrote about is we were ripe for more volatility. And what we're looking at here with this chart are annual returns for the S&P 500 and maximum drawdowns. When we say maximum drawdowns, we mean sell-offs. And history tells us that we should expect at least one 10% correction each year. Last year, the drawdown was 3%. This year, we've experienced 2 drawdowns of 10%. So I think his view is if that's not mean reversion, then I don't know what is, making up for last year's lack of a 10% correction and then an additional one this year. So there's nothing surprising to us about the corrections. Slide 21, the second thing you wrote about is that we were ripe for a pause for a year for equities. This doesn't mean it's a bear market or necessarily a negative year, but just something less stellar. And his point here is that there's usually a period of pause for the market to refresh before we move on to new highs. And so what we're seeing here is a bull move, a pause, bull move, and a pause. Specifically, March 9th, 2009 to 2010, the market was up about 86%. In 2011, the market was flat. 2011 to 2014, the market was up 65%. The following year, 2015, it was flat. 2015 to 2017, it was up another 40%. So we've had a very steep ascent, and 2018 being a year of a pause is something that Andrew was looking for at the beginning of the year, and he still believes this to be the case. So he thinks when we look back at this year, it will be a rocky year, because we have a lot more volatility than we've had in the past. With a market that is slightly up for the year, it causes a lot of anxiety. Moving on to slide 22, I think the important thing to take away from this slide is this is a correction in a bull market. And bull market corrections typically follow this W pattern that I'm going to explain here in just a minute. So the W pattern effectively means there's a sell-off in the market, and then there's a retracement of about 50% or so from the prior peak, and then we retest the low before rallying. And we've seen this numerous times in the S&P 500 capital markets. So this is what happened in 2010, the upper left-hand quadrant. We saw a sell-off, we saw a retracement, and we saw another leg down before the market went on to new highs. And in 2011, same thing. Earlier this year, 2017 to 2018, February 7th was the bottom. We saw about a 50% retracement. Then we retested a low at the end of the month, and then we went on to new highs. So the slide at the bottom right looks like it is this similar W pattern. And if we could update this slide for you real time, it'd show us the exact same thing. We had a sell-off, about a 50% retracement, market's up about 6% off the lows. And that just happened in the last couple days. So if this pattern continues, our view would be that we would retest those lows before moving on to new highs. And really what it does is, it just flushes out the weak buyers, especially on that second leg down. And unfortunately for retail investors in particular, that's when we typically see the maximum amount of money coming out of equity mutual funds is on that second leg down. What we should be really focusing on, however, is on slide 23, and that's the bear markets. It's really about the recession, because that's what causes markets to really decline. So these short-term timing calls are always difficult, so we tend to focus our time and energy around, are we facing a recession and what's the probability of that happening? So what we're looking at here, in bear markets, we're defining as a 20% correction or more, and they tend to be caused by recessions. So the first point is, in the last 85 years, the S&P has dropped 20% or more 16 times. 13 out of those 16 times were in front of a recession. So a little over 80% of those bear markets were caused by a recession. As we look at our financial indicators, we have a number of proprietary indicators, both for the U.S. and outside the U.S. That's, I think, one of the benefits of being affiliated with a very large global firm like Morgan Stanley. We have research coming in from around the world that filters into our Global Investment Committee. We do not see any flashing or warning signs of recession. So our view, and this is the takeaway from this slide, is that this is a correction in a bull market, not the beginning of a bear market driven by a recession.
That projected through 2019?
At this point, that is our view. I'm sure the Global Investment Committee in probably early December will release our official views for the new year, but that is our view at the moment. And also, 2019 earnings continue to go up. And so for us, that's also a very healthy sign. I know strategists have said those earnings numbers have to come down. Maybe they come down a little bit, but our view is they're still going to be positive for next year.
Just ask one question real quick,
Yeah.
since you mentioned the investment committee. Is there a investment committee at the Greystone level? And is there also sort of a Morgan Stanley investment committee? And do y'all interact, have someone at your,
Yes, good question.
on your committee, on their committee?
Yeah, so Greystone has its own CIO and its own investment committee, and they interface with the broader Global Investment Committee at Morgan Stanley. The next slide I'd like to cover is on slide 24. This would be one of my favorite slides, because it's not only because it gets a lot of attention, but I think it tells us a lot about the health of the U.S. economy. So there's a lot of information on this slide, I admit that. So let me walk you through what that is. If we start at the upper left part of the slide, you could see the indicators of each of the descriptors. The first is the 2-year versus the 10-year Treasury spread. And what we're looking at here is the difference in the yield between the 10-year U.S. Treasury and the 2-year U.S. Treasury. Normally, in the capital markets, there's this concept called the term structure of interest rates. So the longer you go out on the yield curve, the higher the coupon, higher rate of return you expect for taking additional risk. So you should get paid more if you're buying a 10-year U.S. Treasury or a 10-year corporate bond versus a 2-year Treasury or a 2-year corporate bond. And that slope, that spread, is normally positive. What happens, however, is as we approach a recession, it gets inverted. And the yield on the 2-year Treasury is more than the 10-year Treasury. So I'll come back to address that in a second. The blue line is the Fed funds rate. The gray barred area is for recessions that have taken place. And the green dot is the initial point of the yield curve inversion. So that's when that term structure of interest rates became flipped. And there's a lot of discussion in the capital markets about once there is an inversion, that's an immediate indicator of a recession. And what we're highlighting here is, yes, that 2-year, 10-year spread has narrowed. It actually got down to 18 basis points on August 24th. It is now widened a little bit. It's about 27 basis points today. And so it's actually gone up. So we think this is not indicative of a recession, but we think it's more of a growth slowdown. And that's, as I said from the prior page, that's a very important distinction for us. Furthermore, I think if we look at how the stock market has behaved when there actually has been an inversion, that's what we see at the bottom of the slide. So at the bottom left, you see the initial inversion dates, and then you see where the stock market's peaked. And then to the far right, you see the S&P gain from the inversion to peak. So what this means is history tells us that when there is an inversion, it doesn't necessarily mean that equity prices are going to roll over. Actually, it's just the opposite, is that when there is an inversion, equity prices tend to perform quite well subsequent to the inversion. I think there's a lot of misinformation in the capital markets about yield curve inversions. On slide 25, the outlook is actually quite positive if there's no recession in sight. So what we're looking at here is the S&P 500 10% decline from 52-week high with no recession. We have 10 data points, and the returns after 10% correction are pretty good. That's what this slide tends to indicate to us. So the returns going out 3, 6 months, 1 year look very strong. And if we take out 1987, the frequency is even more positive than what you see at the bottom of the slide. So 75% of the time, 1 year later, the markets are positive. Again, if we strip out 87, that number goes up pretty substantially. On slide 26, here we're looking at the cheapest stocks. Really, it's the cheapest decile, and how cheap are they relative to the market and relative to history. And the reason we include this slide is because some of the extremes in the equity markets are starting to revert, which we think are healthy. And what we're looking at here is some of the steam has come out of momentum and growth stocks, which became crowded, too expensive, and that part of the market is starting to revert. That's where we saw quite a bit of damage during this last correction. And if we looked at those individual stocks, you probably all would have recognized some of the growth stocks that have been driving the markets: Amazon, Google, Microsoft, et cetera. So this has created what appears to be an opportunity in value. So value to us looks pretty cheap relative to history. Again, we highlight in the black circle 3 recessionary environments. So if we are entering a recession, then value isn't cheap, but we don't think that that's the case. The last time we got this cheap on the value side was February of 2016. And if you recall, that's when energy prices, oil prices in particular, rolled over, and there was concern about banks' exposure to energy, which turned out, in hindsight, to be not such a serious event, and value went on to rally about almost 30%. Slide 27 is the other extreme we think that is likely to revert, and this is the underperformance of the rest of the world versus the U.S. So what we're looking at here on the left is the rolling 12-month returns of the S&P, essentially versus the rest of the world ex-U.S. And so when that line is going up, it shows you how much the U.S. market is outperforming the rest of the world. And what this chart shows us going back to 1998, it's pretty dramatic. So we think that this will revert. The other capital markets around the world, we've talked about this at a number of our investment meetings prior quarters. We think that emerging markets, non-U.S. equities will perform better on a go-forward basis. Just don't know when it starts, but this extreme valuation helps support that. I think the other thing that helps us understand this is during this last sell-off, and that's what we're looking at here from September 7th to October 25th, the S&P was down a little over 7%, and the world index was down less, 6.45%. And typically what we see is when the U.S. market sells off, foreign markets sell off even more. And the reason is because there's higher beta in those markets and there's higher volatility. This time around during the sell-off, we didn't see it. So we think the market might be starting to understand the value differential, and perhaps it's the beginning of a shift of relative performance between U.S. and non-U.S. Any questions? I hope you thought that was more helpful than going through the standard second, third quarter macro slides. We wanted to give you as much as we could a real-time update about what's happening and put it all in perspective for you.
What is your current analysis on the trade situation and the impact on the economy? I see the look at the rates, and you're indicating that the inverted curve may not be such a big impact on the economy, but what about the trade situation?
Trade wars are always very serious, and we think it becomes an issue that will get magnified from here. But at the end, we think the current administration understands the importance and the benefit of trade. They're just trying to level set, particularly our relationships with China. I think they're adamant that they feel like those have been abused, and they want to improve that. The U.S. government got better terms out of Canada and better terms out of Mexico, and we think we're going to get better terms out of China as
Do your
well.
folks see that happening as the Chinese economy continues to weaken?
We think, is it tied to the potential trade wars?
Yeah.
Yes, absolutely.
So are your analysis then, you think that it's more of a short-term impact than a longer term?
That's right. So we don't think this is going to be a multi-year protracted problem for the financial markets.
Okay.
And look how quickly the Canadian and Mexican government resolved the trading wars. China just happens to be more complex exponentially, so it's going to take longer. But if you look at the impact to the Chinese currency, emerging market currencies, China's growth, it's already being impactful. And that's really the last thing the Chinese government wants to have happen, is a further contraction of not only the stock market, but their growth.
And they're taking other measures too to stimulate the economy more sort of domestically outside of sort of the trade relationship. So I think there's a lot of things going on in China that they're trying to do to improve the economy. But to Jim's point, I do think resolution of the trade issues and all this, shouting and finger pointing will help them as well. So, and that's why they'll come to the table and negotiate something.
Yep. And resolution of Brexit will help the international markets as well, which we do think gets resolved. So any questions about the third quarter market performance or the economic slides that I just reviewed with you all? Happy to take further questions. Thank you. I will turn it back to Brian for a review of the portfolio.
Thanks, Jim. So I'm going to use a lot of what Jim talked about, not only from the third quarter perspective and what was going on in the capital markets, the broader economy, but also kind of what we've started to see in October and the early part of November here. Again, it's Jim talked about S&P 500 being up over 7.5% in the third quarter. It's pretty much down about as much in October, and with the outcome of the elections and the uncertainty that potentially had as an overhang on the markets, that being resolved. Again, yesterday we saw just a massive rally.
Brian, maybe
a
word for the group about why the market rallied.
As much as we hate it as citizens, and this isn't a political statement, and I want to make that clear, the market loves gridlock. It means one party can't implement everything it wants to do. And with the Democrats taking over the House, it means that pushing through one side's agenda becomes much more difficult today, or when the new Congress gets seated, than it was before the election. And so I think that's why we saw such a massive rally in the market yesterday. I think the Dow was up 550 points, something like that. It was, I think, again, not political, and I don't mean to offend anybody, but a relief rally that
The market likes certainty.
That's right. And any time, and it could be political, it could be economic, it could be wars, it could be anything. Any uncertainty with respect to things going on in the world, again, politically or economically, is bad for stocks. We had an election, stocks sold off because of that uncertainty. It got the outcome, I think, probably that it was looking for, and that's why you saw the massive rally. It's not to say we go straight up from here, because as Jim talked about, we don't think that's necessarily the case, but at least for the time being, and I don't know what's happening this morning yet, but things are pretty okay.
Slightly down.
Slightly down. Okay.
Maybe this is the right side of the W.
Right. as Cub fans, we know the W. We fly the W sign when the Cubs win. So hopefully that means good things for the market too.
I said that was straight down for 100 years.
Yeah, probably a bad analogy.
Big W.
That's right. That's right. Okay, so behind tab 3, we're going to talk about third quarter results, and I'll give you an update for the month of October, just to show you where things stand there. So on page 37, here's how we're allocated at the end of the third quarter. Go all the way down to the bottom of the page, and I recognize there's a lot of numbers here, but about $214 million in assets. All the numbers above it are the individual managers and asset classes that we have exposure to. We have the most of our money in U.S. equities, both large and small company stocks. About 43% of our plan at the end of September was a little bit overweighted versus what our target is. Our target's 38%, so we were about 5 percentage points overweight. And in the third quarter, that was a good place to be. And yesterday was a good place to be as well. So overweight U.S. equities relative to non-U.S. equities and fixed income. Non-U.S. equities, both emerging and developed markets, we've got about 30% of our portfolio there. Got a little bit in REITs, about 20% in U.S. bonds, and you can see the remainder. With the exception of that slight overweight to U.S. equities at the end of September, we're pretty close to what our target exposures are intended to be according to our investment policy statement. Again, those targets might change based on this asset liability review we're going to go through, but as of today, that's where we stand. So in light of pretty strong U.S. equity market returns in the third quarter, maybe a little less constructive equity markets overseas, on page 38 for the third quarter, our fund was up a little bit north of 2%. We're up 2.1%. We show two different benchmarks. One is what we call manager benchmarks here. So this is a weighted average of each manager's individual benchmarks. And the reason that we show that is because the legacy exposure to that Schaefer-Cullen portfolio was very significant. At one point, they represented 40% of our total fund assets. And when we got involved at a more sort of strategic level 18 months ago, we took that 40% down. We felt that was too high. And just for the new members' benefit, Schaefer-Cullen portfolio, you could think about what they do in the context of being they invest in equities, but they're very defensive equities. So they tend to invest in stocks that pay dividends, and oftentimes very high dividends, very stable businesses. Those are good things. But as Jim talked about, the companies that were really driving the stock market's return were things like Amazon and Apple and Google. It's these high growth kinds of companies, which Schaefer-Cullen doesn't invest in as a matter of policy and a matter of strategy. So when you look at the return that they've generated relative to the broad market, it doesn't look so great because they are much more defensive when equity markets were going straight up. But when you look at the return relative to maybe a more defensive equity market benchmark, they look a lot better. So that's why we show this weighted average of individual manager benchmarks as a sort of a yardstick on program success. Now, we underperformed that by about 40 basis points in the third quarter. We'll talk about individual manager performance in a second, but I think it's important to point that out. The second from the bottom row in this table here is something called the policy portfolio. So the policy portfolio just says, look, we've got 38% of our total fund. We're supposed to have 38% of our total fund in U.S. stocks. Well, what's a broad representation of the U.S. stock market? There's a lot of different benchmarks out there, but the Russell 3000 is a pretty broad representation of the total U.S. stock market. It has big cap stocks, it has small cap stocks, it has growth stocks, it has value, really balanced, really diversified. And so that's the kinds of exposures that roll up to this policy portfolio. It's irrespective of what any individual manager is doing and just looking at broad, diversified exposures across markets. That portfolio's return was closer to 3%, so we underperformed that one as well in the third quarter. That underperformance is going to be driven significantly by, especially over longer periods of time, significantly by the fact that we have, with a big chunk of our allocation, granted it's less today than it was 12 months ago, that defensive equity exposure when stocks had gone straight up. Over the 9 months through September, we were up about 1% in our total fund. We underperformed both benchmarks, and you can see the 3-year results. Again, I can't hit this point enough, and I just want to make sure it's clear. And this is in no way me, trust me, being defensive here, but our involvement with the plan doesn't extend back, very long in terms of where we had broad exposure or broad oversight of the plan. So take some of these numbers with a grain of salt. I think with the new relationship in place, one of the things we want to do from a performance reporting perspective is start showing performance as of 11/1 of this year. Not to say we're going to completely forget about everything in the past. We'll still continue to periodically show you those numbers, but the clock in our mind really starts with the new relationship, where we're much more responsible for manager selection, for taking control on a discretionary basis for the plan.
Can I ask one quick question?
Yeah.
So we're basically a 70-30 portfolio.
Right. Yeah.
I don't think you have it in here, but do you know generally how your volatility is running relative to the generic 70-30?
We do, and it's on the next page. So let's go there. And I think what you're talking about is on the chart on the top on the right-hand side there. So this is looking at the last 5 years. Risk is on the vertical, return is on the vertical axis. Risk or volatility of returns is on the horizontal axis. And we plot this line between the policy portfolio, again, I kind of described what that is, and Treasury bills, which over this period basically had no return and basically no risk. So that represents the true theoretical definition of a risk-free rate. Basically anything on that diagonal line would mean that our risk-adjusted return matched what the market's risk-adjusted return was. Our dot falls below, so that means a lower return, but it plots to the left as well. That means less volatility than that 70-30 mix that you talked about. So the return was below what it should be. There's no question about that, because of that defensive nature of that portfolio when stocks had gone straight up, but the volatility was less as well. We're still not happy with this result, by the way, because we're below the line. But if we happen to be, the way to think about this line is if we were here, we had a lower return, but lower volatility, but we plotted on the line, we would be pretty okay with that result. What you want to see as much as possible is be to the upper left-hand part of that chart, and that's representative of better returns, lower level of volatility. Okay. I want to spend a minute on the graph on the left-hand side here, on the top there, attribution analysis for the third quarter. So I talked about on the prior slide the fact that we underperformed that policy portfolio by about 80 basis points. What we're trying to do here in this chart is to say, okay, where is that 80 basis points of underperformance coming from? Now we have investments in U.S. stock, non-U.S. stock, bonds, et cetera. And so those managers that make up those exposures are either outperforming or underperforming their benchmarks. And we'll look at individual manager performance in a second. But you can clearly see the two primary causes of our underperformance in the third quarter. The biggest one being the performance of non-U.S. stocks. So our managers within that bucket, and we've got 3 of them, lagged the overall non-U.S. equity benchmark. And the primary reason for that is because we have a fairly significant allocation to emerging markets, and we have an overweight to emerging markets relative to the broad non-U.S. equity benchmark. As Jim talked about, those markets in particular, not only did they lag the U.S., but they lagged developed non-U.S. equity markets in the third quarter as well. So that that kind of exposure, and our manager in that market underperformed as well. It's come back, and we'll show you that, but at least in the third quarter, that's what was contributing significantly to that 80 basis points of underperformance at the total fund level. The other impact that was, the other negative impact was in the U.S. stock bucket. 2 things going on there. We've got 3 active managers there, 1 index fund. So we already talked about the defensive nature of that Schaefer-Cullen portfolio. S&P 500 was up over 7.5% during the third quarter. Schaefer-Cullen was up under 7%. So they actually did a lot better than their benchmark that reflects their defensive nature. But they lagged that S&P 500 because they were much more defensive. And then our small and mid-cap growth manager, Rice Hall James, we'll see in a second, had a little bit of underperformance as well. So those two factors contributed to that 27 basis points of the 80 or so of our underperformance at the total fund level. The only other thing I'll point out here on this chart is if you go sort of down to the bottom, there's something here called the allocation effect. And the first thing I showed you when we started talking about results is how we're allocated relative to our targets. We had about a 43% allocation to U.S. stocks. Our target is 38. Again, that's been a good place to be in the third quarter. And that actually added some value. It added about 20 basis points to the total fund, the fact that we were overweight a market that was doing really, really well in the third quarter. So any questions about how to interpret or read this graph here? The other two charts on this page on the bottom left is just the quarterly return of our fund relative to that policy portfolio. You can see there's a lot of red here that's reflective of underperformance. Again, a lot of that coming from the defensive nature of the Schaefer-Cullen portfolio. And then results relative to other public funds, where you can see that for over time, we're sort of in that bottom quartile of results. Our goal, of course, is to improve that over time. And, that's part of what we're going to look at with the investment committee on what the right strategy is. Knowing what the practices of other public pension plans, I think, can be insightful. You never want to do something simply because somebody else is doing it, because our circumstances are very different here than they might be at VRS or some other larger plan. But it's always, I think, instructive to know what's going on at other places. So let's talk about individual manager returns on the next two pages. On page 40, we'll take a look at the equity manager performance. We showed over the third quarter year to date, and then for those managers that have been in place, the longer history. And then on the next slide, we'll look at the fixed income managers and some of the other managers we have in place as well. I talked about Schaefer-Cullen a little bit. So their return in the third quarter was just north of 6.5%. And by the way, all these are net of fees. So after all the fees have been paid, what has their return been? So it was about 6.5% in the third quarter. Their benchmark is this thing called the CBOE Buy Right Index. So let me just describe what that is, and it kind of relates to what the underlying strategy of Schaefer-Cullen is. So the CBOE Buy Right Index basically invests in the S&P 500. And then what the index does is it goes into the options market. If the S&P 500 is at 2,000, we'll go into the option market and say, I want to cap my upside at 2,100. And by doing that, you basically go into the market, you sell options at 2,100, and when the stock market goes above 2,100, you don't participate in any of the upside above that. But what it does is if you sell away that upside, it gives you some premium and some cash flow to protect you on the downside. So it doesn't do as badly when things go down. And that's effectively what Schaefer-Cullen is doing. Now, they're not buying the S&P 500, they're buying individual stocks, and they've got they got a portfolio of, 70 names. It tends to be those companies that we all know, those companies that pay dividends, consumer product companies. Think Coca-Cola, and although they don't hold the stock, in the heyday it was GE. It was, big brand name companies, everybody knew, broadly diversified, paid dividends, strong brands, can weather downturns in the economy. But again, it's those stocks, those are the exact stocks that have done the worst in this sort of multi-year bull market run coming out of the global financial crisis. So they invest in those kinds of stocks. And then what they do for 30% of the portfolio is they sell away a lot of the upside in those stocks to protect more on the downside. So we had sort of the double whammy with this portfolio. We were investing in defensive stocks when it was the growth stocks that were rallying, and they're selling away some of the upside. So that's why you see, I mean, 6.5% return in a quarter is pretty good. And it's a lot better than what that benchmark did, but it wasn't as good as the 7.7% return of the S&P 500. So that's, when we talk about the defensive nature of the portfolio, that's what we really mean. And that's what we're trying to manage. And just to remind the group, when we came, when we talked to the previous CFO about making some changes to the program, this is, again, going back 18 months, this portfolio was somewhere north of $90 million. We've taken that portfolio down in steps to where it is today, about $35 million. You should expect to see us to continue to do that. We're sticking with it. It's worked pretty well in the correction that we've had, and we'll show you in a second. But the fact that we don't see a recession coming, the fact that we don't think this is the start of a bear market, you should expect us to take some of that defensive exposure and get it in something that looks more like the portfolio that's below that, this Vanguard Institutional Index Fund. This is an S&P 500 index fund. It's not an active manager. It's not trying to beat the market. Whatever the market does, this is going to generate the same return within a very small margin of error. So if we have higher equity markets, we're going to participate more fully in those markets. And that's how, and that's part of how you're going to start to see some improved results.
Just to add a comment to that, because when we're looking at the historical policy portfolio and the performance, I think it's easy to provide hindsight analysis and say, well, we would have been better off putting that money in an S&P 500 index. That's an easy statement for all of us to make in hindsight. But I think you have to give credit to the investment committee at the time, or at least acknowledge for them that I believe the start date was 2011. That there might have been some logic or rationale for investing more defensively at that time. These are very uncertain economic times. And you think about this portfolio. If I showed you the name of the stocks, they're all blue chip companies. You'd recognize everyone. Balance sheets are a fortress. It's paying about 3% dividend yield. The call options that Brian mentioned that they write against, about half of the portfolio generates another 3.5% of current income. So you're getting blue chip exposure, and you're getting approximately 7% yield on a stock portfolio. So I just want to put it all in perspective. And I've been pretty vocal about what the historical policy benchmark has been and whether or not it's appropriate to apply a Russell 3000, a broad benchmark, as really the policy portfolio index, when that wasn't the risk level that the committee was looking to take at that time. I think what we're suggesting is it's difficult to time these markets, and we want to have a very long-term view of each of these asset classes, and that's what we'll be focusing on with the investment committee. But since this meeting is really in part built around providing you historical perspective, I just wanted to share those comments about the construct of the Schaefer-Cohen Premium Dividend Portfolio with you.
Right below that S&P 500 index line, Goldman Sachs, they're a small cap value manager for us. Almost 3.5% in this third quarter. The Russell 2000 Value Index, an index of small cap value stocks, 1.6%. So, a little more than double the index's return in the third quarter. Over the year to date, we've got some lagging performance. Over 5 years, you can see a little bit better. This has been an investment that has been in place in the plan for a long time. And over a long period of time, they've done well. Over shorter periods of time, you'll get periods like you see in the year-to-date period, a couple of hundred basis points one way or another. But over a long period of time, they've done well. Rice Hall James is a small and mid-cap growth-oriented manager. This is a manager that we worked with the board on bringing in place about 12 months ago or so. And in the past, we had another small cap or mid cap value manager. So we had a lot of value exposure in this portfolio. And one of the first things we did was to get more kind of balanced exposure between growth and value. So we terminated that old value-oriented manager and invested in this Rice Hall James, which is much more of a growth-oriented manager. And you can see over the year-to-date period, they're up double digits, 17%, beating the benchmark by 120 basis points. The interesting thing about it is if you look at that Russell 2500 growth index return of about 16% and compare it to the value, which is 7%. So that trade, that move away from value more into growth has been really beneficial for the plan over the last 12 months at least. The next two managers are largely developed, but non-U.S. equity managers. The American Funds Euro Pacific Growth Fund, Lazard is a new manager that's in place. Lazard's return is over both periods here is in line with what the overall market's return was. During the quarter, the Euro Pacific Growth Fund underperformed by about 1.5%, but slightly ahead over the year-to-date period. This is a portfolio that has about 25% of its, is a manager that has about 25% of its portfolio in emerging markets. And since emerging markets have been so weak over the recent past, I think that's a big reason why you see some underperformance coming through from that portfolio, at least over the third quarter. And then speaking of emerging markets, that's the last two rows here. The benchmark was down a little bit north of 1%. For the quarter, year-to-date period down about 7.5%, a little bit more than 7.5%. And our manager there, this Artisan Developing Market portfolio, underperformed over both periods. They have a sizable allocation to places like China. China's been a really tough place to be over the recent past. Now, a lot of those stocks have come back a little bit. And so the trend in that manager's performance has started to turn, particularly in the downdraft that we saw in October. And we'll talk about that in a second.
Can I ask a couple questions about that one? And do you know how their strategy tries to add value? Is it by country selection sectors, or is it literally just try to pick the best companies?
They try to pick the best companies, and they try to pick the best companies that are leveraged to things going on in emerging markets. And that doesn't necessarily mean that they're investing in stocks that are traded in emerging markets. So I'll give you an example. I think the number is something like 80% of Facebook users are located outside the United States, and in particular in emerging market countries. So Facebook is a holding of theirs. So what they're really trying to capture are those dynamics that are going on in emerging economies. And some of those dynamics are better demographics, younger people, embracing more technology. But the real benefit of investing in emerging markets is that the wealth creation that has gone on in those markets is significant, and so people have much more disposable income and can buy things that we take for granted in this country. So in India, people are buying refrigerators for the first time ever. And so what does that mean? Well, that has implications for consumer products companies. It has implications for food companies. But it's that massive sort of middle-class wealth creation that's going on in those economies, and what that means for the domestic consumption story that's going on in those economies is what they're trying to focus on.
So it's like macro and demographic sort of themes?
But at the individual company level. So which company is likely to benefit from those bigger kind of developing things? Now, those aren't straight line kinds of trends. It's, it's bouncy, it's volatile, but the trend, the long-term trend in terms of domestic consumption in those economies is clearly strong.
The emerging consumer.
Yep.
And what kind of tracking area do those kind of funds generally target?
Yeah,
it's got to be pretty big.
Yeah, so you go from big cap U.S. stocks, the tracking error, so the the way to think about tracking error is how different would their return be relative to their benchmark. So in large cap US stocks, that difference is pretty small. Call it, I don't know, maybe 100 basis points. When you get into small cap US stocks, it starts to get bigger. You could think about tracking error, difference in return relative to the benchmark, probably in the, I don't know, call it the 300 to 400 basis point range, 3 to 4 percentage points. When you get to emerging markets, it gets really big. The more volatile the market, the wider the tracking error, the bigger the difference in performance it could be for a manager relative to its benchmark. I would say probably, on average, probably around 5%, 500 basis points. Okay. Let's flip to slide 41 quickly. I'll run through some of these, and then we'll just kind of touch on October, and then I'm happy, again, to address any questions. So the first three managers here are our U.S. fixed income managers. BlackRock, we've got a Lord Abbett short duration portfolio and an unconstrained bond portfolio. Just a quick word on unconstrained bonds. What does that really mean, that it's unconstrained? Basically, they can invest in anything, wherever they see, as long as it's a bond. Wherever they see value, if it's in U.S. bond market or non-U.S. bond markets, or corporate bonds or government bonds, or short maturities or long maturities, this manager can go wherever it finds value. So it's a highly opportunistic, highly flexible strategy that over a long period of time does pretty well. In fact, over the year-to-date period, it's down 1%. Now, that's not a great result, right? Nobody likes to lose money, but it is down less than what the market's return was, which was down 1.6%. I think it's important to point out that this collection of three managers we have here, we consciously put this portfolio together because when we got involved, again, around 18 months ago, our outlook at that point, and it's still true today, was we thought interest rates were going to be higher in the future than where they were at that point. And when interest rates go up, it's really bad for bonds. So the way you mitigate some of the impact of interest rates going up on bond investments is that you have shorter maturity bonds. And that's basically what this portfolio does. BlackRock looks an awful lot like this Barclays Aggregate Index, but those two other managers, Lord Abbett and Reams, very much shorter duration, shorter maturity profiles. And when interest rates go up, they're going to outperform. And that's, in fact, what we've seen with both of those managers. We've seen outperformance from those managers because rates have gone up. The other interesting bond manager we have in place, and this is a global bond manager, is Templeton. So it invests outside the United States. Interestingly enough, they actually have some investments in the U.S. bond market, but their investments they have are short, meaning negative maturity. So when interest rates go, they have negative maturity to U.S. Treasuries, basically a negative allocation to U.S. Treasuries. And so when interest rates in the U.S. go up, it's bad if you actually hold U.S. Treasuries, but if you have negative U.S. Treasury exposure, so shorting U.S. Treasuries, when interest rates go up, they actually make money. And that's why you see in the third quarter, they're up 1%. And they've continued to do extremely well as interest rates in the United States have gone up. So this is going to be an important exposure for us going forward, something that, just because there's this belief out there that because interest rates are going to go up in the United States, I don't want to hold any bonds and I'm going to get more money in stocks. We think that's a bad idea because obviously stocks are much more risky than bonds. There are certain things we can do in the bond market that are actually going to make us money if interest rates go up, and that view continues to materialize. This is one of those ideas. We've got some REIT exposure below that with Principal Global REITs and the Vanguard US REIT Index Fund. Nothing too exciting going down on there in the third quarter. And AQR is a managed futures portfolio. It did pretty well in the third quarter, 2.8 versus a cash return of about 0.5%. But you can see the longer term story is a little bit tough there. Let me talk a little bit about, on page 42, October. As Jim talked about, it was a pretty And I sort of alluded to in my opening comments, a pretty stark difference between the third quarter and what actually started to happen in October. Just at a high level, we were down at the total fund level a little bit more than 5%, 5.3%. That policy portfolio was down about 5.7%. You can see what the impact on the year-to-date period through October is. But let's talk a little bit about individual manager portfolios. We talked a lot about the defensive nature of that Schaefer-Cullen portfolio. When we talk about defensive, doesn't mean it's not going to go down. In fact, that's what we saw in October. The Schaefer-Cullen portfolio went down about 3.2%, but go down a couple of lines to the S&P 500. The S&P 500 was down almost 7%, so it went down half as much. And that is what we would expect. When markets pull back, this portfolio should outperform dramatically. Goldman Sachs, our small cap value manager, in line. Rice Hall James in line. The developed non-U.S. equity managers, given their emerging market exposure, was a little challenged with that Euro-Pacific Growth Fund and Lazard. Artisan was down over 6, but the market was down about 9. So again, some of those trends that didn't work in the third quarter are starting to play out for Artisan here in the early part of the fourth quarter. They're now down about 200 basis points for the year-to-date period. Those numbers continue to improve even in the early part of November. On the bond side, we continue to see, on the right-hand side of this table here, we continue to see interest rates increase in the U.S., and that's why you see negative returns with those three managers there. Again, a little bit better than the overall market, but look at that Templeton number. Again, 1.7% in a bond market that was negative. That's a pretty strong result there. And then for the smaller allocations through the REITs and AQR, you can see the results there. So, look, October, not a huge surprise. It's always difficult to go through it, as Jim talked about. We're sort of waiting for this. This market was sort of ripe for a pullback, given that we hadn't really seen one last year. What we're seeing here in this market, again, although it's painful, it's not unusual. It's not a precursor to what we think is more difficult economic times. It's just sort of a pause in the strong rally that we've experienced, and so we're encouraging clients to, let's stay focused on the long term. We don't see anything in the near-term horizon that causes us concern from an economic or a capital market perspective. We think we're pretty well positioned, and as we work through that asset liability study with the investment committee and board, there's probably going to be some changes that are made. But we'll see where that takes us and where the board wants to go. Yes, sir.
Am I reading this correctly, where the total portfolio is down 4.6% for the year?
Correct.
Year to date?
Year to date through October.
Now that you've got discretionary, you can change that, right?
Well, we hope.
That's the goal.
That's the goal. There's a bunch of other more sort of detailed analytics on the individual managers further back, but in the interest of time, I think I'll just kind of stop there and see if anybody has any questions.
Yeah.
Any questions? All right. I think questions were posed as we went along.
Terrific.
So thank you, Brian. Jim? Before we move to adjourn, I have one thing to propose. We already determined that our investment committee and the strategy development will occur next year. And the OPEB information that we were seeking, that's not an urgent matter either, since it's next fall of 2019. But we still ask that you be prepared to talk with us more about that. So I'm proposing that we meet again in January rather than December. The board doesn't need to approve retirees and those things that just kind of happen automatically. But I'll put that out as a suggestion to the board and see what your thoughts are.
Barring something unusual, you can always make a called meeting, so yeah.
That's right. I'm good with that.
I guess what's the normal schedule is what, every other month? So
Every
we-
month.
Every month.
Every
Oh, so it doesn't even, yeah.
Every
So
month.
just skip one meeting in December?
Skip December. And then I also asked that, I know that the suggestion, Ryan, was that the investment committee meeting mid-January, but if you all could move that up, even if it's a day or two, so we have some idea.
Sure.
By our next meeting
Sure.
in January, where you guys are trending. I think that would be helpful to us.
Okay.
One question, does this board have bylaws?
Yes, we have bylaws.
Do the
In
bylaws
fact,
allow us to skip?
Yes.
Okay.
It does. It's discretion of
Okay.
the board. So, and I suppose then I'll need a motion to,
So moved.
a second? Yes.
I mentioned earlier in the meeting that I had some information that both the retirement board and city council had
That's true.
requested.
It didn't make the agenda, so I'm
It
sorry I overlooked it.
It didn't. It came up, I guess, after the agenda. Just, I will be making a presentation to city council next week on the information that was requested. A couple of pieces of it were asset allocation, both asset allocation and regional allocation. That information was provided by Greystone, and it is as of June 30. Now I won't go through that because you've gotten a much more detailed picture of that today. There's also going to be a chart that shows our investment return from 2007 to 2018. That was the period of time as that the information was available. So that looks like returns went from a high in 2007 of 15.9% to a low in 2009 of negative 22.7%, and ended fiscal 18 at 4.7%.
4.7 annualized?
Just for the plan year, yeah, for the 12 months ending June of 2018.
Do you know what the 10-year annualized return is? Is that in here?
It's not in here.
I only have 5.
We're also showing the actuarial accrued liability funded ratio. So, the amount that we're funding of our liability. That graph goes from 2007 to 2018, and it's so in 2000. It got to its lowest in 2012 when fire and police was at 31.7% and supplemental was at 28.4%. That's when we issued the pension bonds, and that influx of money, of course, the city is paying $11 million a year debt service on, got the funding level up to 76.9% fire and police and 76.1% for supplemental. Since then, we've been moving in a downward trend, a much smaller downward trend than the increase we got from selling the bonds. But the result was that we ended fiscal 18 with police funding at 69.8% and the supplemental at 72.4%. The City Council asked for number of a chart on plan participants. You get more information. This is summarized, so I won't go through that as well. But it's just on an annual basis how many active, how many we have in pay status. Then the the comparison that was requested, we looked at both the rate of returns and the funded ratio for all of the municipal pensions, municipal funded pensions in the state of Virginia. And as far as the rates of returns go, the almost all of us, our trends went the same. Some outperform, but we never had a year where we went in a different direction than the others. And then for the funded ratio, we have, for most of the pensions, we have 3 years of information, fiscal 15, 16, and 17, for ours as well as Norfolk's and Richmond and Roanoke. We have 18 as well. And those, it shows funding, funding levels. Falls Church is very well funded at over 100%. Then when we get down to, there are some that are funded above 80. Arlington County, Alexandria, Danville, already mentioned Falls Church, and Norfolk seems to stay around that 80%. So we're slightly below them, and then everyone else is in about the same range, with the exception of Charlottesville, and they are they're in the 50s, the 50s range, high 50s. So we will, Mr. Ash.
Can we get that email to us?
Yes.
Okay.
We wanted to make sure we got it to you and City Council at the same time. So when we get the packet out to City Council, we'll get it out to you as well.
Thank you, Cheryl. I didn't mean to overlook that.
Oh, no, that's, no, it's, didn't make it to the agenda.
All right. Any other new business or old business or questions? I think you had a question about what she just presented, so we did.
She gave me the information I was
Okay.
looking for. Thank
All
you.
right.
I just had one thing to be added for January, is I would like to add for the agenda. It so happened I was looking and saw this article that addressed missing participants as it relates to the IRS guidance requirements with respect to finding beneficiaries and participants of plans. And so I would like to draft a proposed bylaw amendment to address that particular issue and provide it to the board for the review, and we can have a discussion on the IRS guidance as it relates to that. And also, if the bylaws is actually approved, then obviously there will have to be a directory to John Hancock as our administrator of the account to actually implement it. So that's something I would like to have added to the agenda for January.
Okay. And speaking of which, since David asked about our bylaws, could you get an update to the new members of the board?
I
think
sent
there
one
were-
to them already.
Okay, you have them already?
Yes, I
Okay.
sent it after the last
In
meeting.
my file in the drawer then.
Okay.
I should look at it, huh?
All right. All right. Well, anything, if nothing else, I'll entertain a move to adjourn.
Second.
Before you move, I'm not sure if I missed it. Did you ever vote on the January meeting being in January? I heard the second, but I never heard it being voted on.
All in favor of our next meeting being in January and skipping the December one, say aye.
Aye.
Any opposed?
We were just
All right,
checking. up
motion's
on-
carried. And now I'll entertain a motion to adjourn.
Move to adjourn. Second.
All right, all in favor, aye?
Aye.
All right. Happy holidays.
You too, thank you.
Thanks again.
Thank you.
Thank you.
Thanks, Suzanne. Thanks,
All
Mackenzie.
right, take care. Take care. Happy Thanksgiving.
Yep, bye-bye.
Landon. The